Hi, welcome to this podcast where I'm going to be looking at investment ratios, predominantly aimed for IAL Accounting, but obviously anybody else is free to watch it that wants to. And we're going to go through most of the ratios. The specification I teach needs students to go through. I'm going to cover gearing in a separate podcast. So the 5 ratios I'm going to look at this time, 2 of them really are only there because you need to be able to calculate them to calculate something useful, are earnings per share. Earnings per share is the net profit after tax minus any preference share dividend, and that would only be preference share dividend on unredeemable preference shares, because any other kind of preference share would be included as part of finance costs divided by the number of issued ordinary shares. And what that gives us is the amount of money that is earned and attributable to the shareholders of each share that they own. What's more useful, because market prices of shares obviously value very widely, is the price earnings ratio, commonly called the PE ratio, and that's the market price of a share divided by the earnings per share. And for example, if that's 8.33, that would mean that you'd have to wait 8.3 years for the amount of earnings being made per share to equate to the current price of the share. Ordinarily, you'd want this ratio to be as low as possible, because that means you're getting your profit, enough profit to pay for the share quickly. But the reality is that companies that people perceive are going to have good growth and profit over a number of years tend to have quite high PE ratios. It's not unusual, for example, for tech companies, for that to be over 20 years, perhaps as high as 30 years, because people are expecting a lot of growth in earnings for those companies over coming years. We've then got dividend per share, and again, this one's relatively, it's not really a useful ratio that you would use, but the dividend per share is a total ordinary dividend paid divided by the number of issued ordinary shares. So, for example, if that ratio came in as 7, that would mean that you were going to get £7 of dividend for every ordinary share that you own. It's not particularly useful, again, because the value of those ordinary shares value widely, and the more common one that people would actually use is dividend yield, and that's the dividend paid per share divided by the market price of the share. Normally that's times by 100 and given as a percentage, and that one is quite useful. So for example, if that came up at 3.7%, that would be the same as having a bank account that was paying you 3.7% interest. And then the final one is dividend cover. Dividend cover is a profit after tax minus the preference dividends. So the total amount that in theory the company has earned and compared to its dividends that year, divided by the total ordinary dividend paid. And that would normally be a figure greater than 1, because companies are going to retain some profit for reinvestment to hopefully make more profit in the future, and companies that tend to focus more upon paying back dividends to shareholders, they would tend to still retain some of their profit in a good year so that they can smooth the dividends out, because people that own those types of shares very often, for example, retired people who are looking for a steady income. So we'll have a quick look at a worked example. Okay, here we've got the bottom part of a company income statement. Put the finance costs in there. I don't really need to for any of these ratios. Then we've got profit before tax, 200,000, corporation tax, 50,000. So the profit on ordinary activities after tax for this business is £150,000. They've got 50,000 shares issued, preference dividends, and these are unredeemable preference shares of £20,000, and they paid a dividend of £75,000. And the shares are quite expensive because they are £15 a share. So working out the earnings per share, okay, we're going to look at 130,000 being on the top, because we've got the 150,000 profit, but we're going to take away preference dividends. So there's 130,000 available for the ordinary shareholders, and there are 50,000 ordinary shareholders, so the amount of earnings per share is £2.60 in this example. Okay, we're going to click over now to the second ratio. This one is the more important ratio. Market price of the share was 15. We divide that by the £2.60 that they've been earning per share, and that gives us a PO ratio of 5.77. So basically, the profits that you would earn from one share mean that you would make enough profit in 5.77 years to pay for the £15 share. And that, as I've said, is probably relatively low for most companies now when you look on stock markets and their valuations at the moment. So it might be a company that's going to not grow very much and is trying to pay money back to the investors, or it could be even a company that people are worried about and think that maybe something will be happening to their profits. Dividend per share, well, we know that they paid 75,000 dividends. There were 50,000 shares issued, so for every share that you own, you would get £1.50 paid out in dividends. Pretty straightforward. And then we come to the more important ratio for the for investors, and that's looking at the dividend yield. And for this company, dividend per share was 150. Market price is £15. So multiply the results of that formula by 100, and that tells us they're getting a 10% dividend yield. And when you consider that you're struggling now to get 2% in a bank account, 10% dividend yield on the face of it is very, very good. Although as an investor, you perhaps look at that and think, well, do people know something I don't know if you're looking to buy the shares with it giving a 10% return? Okay, and then down finally to the dividend cover. Well, the dividend cover for this business is 130,000 divided by 75,000, which is 1.73 times. We normally put the times next to that. And with that dividend cover, well, that would be okay if it was an income share where I was expected to get regular incomes and it wasn't going to grow particularly quickly. It would be a very, very low ratio for somebody like Apple at the moment, or Alphabet, who own Google. Okay, there's a student example here for you to do. So you've got the ratios and a different company, and obviously share with me the any answers that you get. Good luck with that, and I'll see you next time.